Good day, everyone, and welcome to another edition of our quarterly market and economic outlook webinar. For those who are new to our company, our vision for our clients to live a life beyond wealth, entrusting us with safeguarding their financial well-being. Joining me today is Nick Downing, CEO and Chief Investment Officer at Overberg Asset Management, a company he founded in 2001. On the agenda today, first up, we've got Global Economic and Market Review, where Nick will unpack the most important developments in the last quarter. Next up, Economic and Market Expectations, giving you insight in what to expect in the coming months. After that, we're going to look at projected asset class returns, giving you an update on what to expect in the coming months from various different asset classes. Then we're going to look at our own portfolios, and Nick will give an update on our performance. And then finally, we're going to summarize and bring it all together. So without further ado, over to you, Nick.
Thank you very much, Carl, for that introduction. So we'll kick off with the economic and market review and outlook. The first segment is a global economic and market review over the last 3 months. The global economy started the year on a solid footing, with growth across most regions picking up momentum. Global GDP grew by 3.2% in 2024, and at the start of the year was expected by the IMF to pick up to 3.3% in both 2025 and 2026. The US economy grew by 2.8% in 2024 and was expected to maintain this pace amid strong consumer spending, rising real incomes, healthy labor demand, and positive wealth effects, with falling inflation enabling the Federal Reserve to continue cutting interest rates. Business investment was also on an upward trajectory. Growth figures beat expectations across the Eurozone, the UK, China, and Japan in the final quarter of 2024, confirming a broadening global expansion in 2025 amid a cyclical upturn in manufacturing and trade. Investors began the year with misplaced optimism that President Trump would promote pro-growth policies and fuel a continuation of the equity bull market. Within his first 100 days in office, Trump instead triggered a stock market crash, undermining the US and global economy. The Liberation Day reciprocal tariffs announced on the 2nd of April were much more severe than expected and are widely viewed by economists as a policy error, threatening to trigger a full-blown crisis of confidence among consumers, businesses, and investors. China's equity market fared better than might be expected, given the 145% tariffs levied against it by the US. China's economy has recently exceeded expectations, with GDP growth of 5% in 2024. Sentiment has improved following the announcement of its homegrown DeepSeek AI chatbot app, developed at a fraction of the cost of US rivals. There has also been a thawing in government's hostility towards the private sector. It is worth noting that China depends on US demand for just 2.8% of its GDP, meaning it won't suffer from the trade war as much as generally expected. Europe provided the biggest upside surprise, with economic data beating projections and the outlook immeasurably improved by Germany's pledge of fiscal expansion. Germany's parliament agreed to reform the debt brake, strict fiscal rule that prevents the federal government's core budget deficit from exceeding 0.35% of GDP Defense spending exceeding 1% of GDP will become exempt from the rule. Also exempt, a deficit finance fund for infrastructure worth 500 billion euros, equivalent to 12% of GDP, will be created and spent over 10 years, amounting to 1.2% of GDP per annum. This marks a seismic shift in policy with significant consequences for economic stimulus. All attention is focused on Trump's trade war and other policies, including suggestions that he may undermine the independence of the Federal Reserve. His unpredictability makes it difficult to predict the ultimate endpoint. The Trump administration has demonstrated a greater willingness of risking a US recession than many anticipated, in turn creating a substantial amount of uncertainty. Policy uncertainty has spiked higher since President Trump's Liberation Day trade tariff announcements. Uncertainty is at levels reached at the height of the COVID pandemic. And now we look forwards, the economic and market expectations. The current trade war represents a serious policy shock. The US and global economic prospects are eroding as trade war uncertainty is undermining confidence. The IMF, in its latest World Economic Outlook, warned that, if sustained, this abrupt increase in tariffs and attendant uncertainty will significantly slow global growth. The report increased the probability of a US recession to nearly 40% from 25% in its previous forecast. The IMF cut its forecast for global growth in 2025 to 2.8%, compared with its forecast of 3.3% at the start of the year. Global trade and global 12-month forward earnings are closely correlated, underscoring the threat of tariffs to corporate profits and equity prices. The US corporate sector has been a huge beneficiary of globalization over the past several decades, which has allowed companies to reduce costs by moving production and supply chains offshore. The government's goal to bring manufacturing back to the US is not positive for corporate profitability. A downturn in sentiment towards the US should benefit other economies, where inflation will be less of a problem. Unlike the Fed, hamstrung by inflationary pressures, other central banks will be able to reduce their interest rates in the coming months, more than they would have been otherwise. The opportunity for fiscal stimulus is also greater in other regions, especially in Europe and in China. An underappreciated consequence of US trade tariffs is the impact of an enforced reduction in the country's trade deficit on foreign investment inflows. The flip side of the massive and persistent US current account deficit is a huge financial account surplus as foreigners recycle their savings into US financial and non-financial assets. The US has run a current account deficit in 43 of the past 44 years. The quid pro quo is that foreign investment inflows into the US have been vast. In the past 10 years, they've amounted to $13.1 trillion, averaging an annual 5% of GDP. The rest of the world now holds $56 trillion of US financial assets, equivalent to 180% of GDP. The forced shrinking of the trade and current account deficit would lead to an exit by foreign investors, potentially leading to a material compression in US asset valuations. The flip side of the massive and persistent US current account deficit is a huge financial account surplus. As foreigners recycle their savings into US financial and non-financial assets, the financial account surplus could unravel in a protracted trade war. Elevated policy uncertainty has tremendously widened the range of plausible economic and financial outcomes. At face value, risks are largely skewed to the downside, with a trade war lifting the potential for recession. However, Trump has been known to backtrack on policies before and may do so again. The 90-day pause on reciprocal tariffs sparked a 9.5% gain in the S&P 500 index, its third biggest single-day percentage gain since 1939. If Trump blinks in the face of market moves or he decides he's received enough trade concessions, he could lift some tariffs and sentiment might turn very quickly. Projected equity index returns. Equity market forecasts for 2025 have been pared back since the launch of Trump's trade war. Positive returns are still expected, although the Eurozone, led by Germany, is now expected to outperform the US. Now we're going to turn to OAM's global portfolios. Our current positioning: portfolio losses in the first quarter were concentrated in our US holdings. They outperformed strongly in 2024, but gave back some of last year's solid returns. We remain confident that US markets, and particularly its technology sector, offer excellent long-term prospects as enthusiasm about AI grows further. We took advantage of price weakness to increase exposure to our core US holdings in the first quarter. But note that in aggregate, total US exposure remains below the global index weighting, which is prudent given the near-term threat from Trump's policy uncertainty. In balanced portfolios, the cash required for the trades was obtained by selling more specialist equity mandates due to their greater inherent volatility, including International Biotech, as well as Vina Capital Vietnam and Schroeder Asia Pacific, all sold prior to the punitive reciprocal tariff announcement. In the growth portfolios, the required cash was generated by selling the more defensive alternative asset class holdings, which show similar risk-reward characteristics to bonds. We purposely avoided any portfolio trades during the period of elevated volatility, which followed the trade war shock. However, once volatility recedes, we will use the opportunity of lower prices to buy quality holdings cheaply. The prime candidate is Europe. We expect the big gains in the first quarter from equities in Europe to be sustained and to gain further momentum. Valuations in Europe remain low, and the shift towards more fiscal spending will have a positive and lasting impact on the region's economy. In coming months, Europe's equity market valuations and earnings growth are likely to be revised substantially higher. The trade war will be disinflationary for Europe due to the strengthening of the euro, the effect of cheap Chinese imports, and the recent drop in natural gas and oil prices, enabling the ECB to cut interest rates by more than previously anticipated. The current environment of extreme policy uncertainty, currency volatility, and pronounced rotation in regional equity market performance vindicate the value of meaningful global portfolio diversification, a cornerstone of OAM's investment strategy. Balanced and defensive portfolios have benefited from exposure to alternative asset classes, including specialized credit, infrastructure, and renewable energy, with an emphasis on generating high dividend yields. These asset classes help to stabilize portfolio returns in volatile and uncertain market conditions. The portfolio also contained gold and absolute return strategies, which tend to have a negative correlation with equity markets. During the month of April, when all markets fell precipitously, BH Macro produced one of its best ever monthly performances. Market volatility has ebbed since Trump's fateful Liberation Day announcements, but uncertainty remains elevated. It is prudent to hold a slightly higher than normal cash weighting, which serves to de-risk portfolios as well as provide buying power for quality holdings at cheap prices. OAM has a long track record in managing global private share portfolios going back to 2002. £100 invested 22 years ago would now be worth close to £500. It has not been a straight line, but it is not timing the market that compounds investment returns. It is all about staying in the market. The annualized return in pound sterling net of all fees is 6.82% over the past 22 years. In round terms, 9.32%. Asset allocation and global allocation is diversified across asset classes, across regions, and across currencies. It is a global, actively managed, multi-asset class portfolio. The balanced portfolio shows a similar trajectory, although due to its lower equity exposure, exhibits less volatility. Surprisingly, the annualized return is in fact slightly above that of the growth portfolio. This is due to unusually strong returns in the bond market in the decade following the 2008-2009 global financial crisis. So let's wrap it up with a summary. The current trade war represents a serious policy shock. Policy uncertainty undermines confidence among consumers, businesses, and investors. The US will come off worst. Its trade policy has already sparked a massive outflow from US financial markets. The threat of recession has increased, but at any point, sentiment can improve if policy is reversed. As things stand, market risks are currently tipped to the downside, demanding a higher than normal cash reserve in portfolios. Weaker markets create a golden opportunity to buy quality assets at cheaper prices. Thank you for attending our webinar. Please contact us if you would like any further information or have any questions.